Recording has started.
All right, go ahead, Laura.
Okay, let's call this meeting to order. If we can do a roll call vote
Laura Negro,
here.
Pat Kinney,
Let's see.
Pat, can you hear me?
I see him. He's not having a lot of,
Yeah, he's talking, but we don't hear him.
he'll have to pantomime.
Ron,
Ron's here.
thank you. Marty Vitek. And Mike Berlin is excused.
Okay,
And we also have Chairman Poopall here.
okay. Next is approval of the agenda.
Laura, can you hear me?
Ah, there we go. I hear you,
Oh,
Pat.
Someone else.
Anyways, do I have a motion to approve the agenda?
Clark, can you hear me? This is Pat.
Yep, we can hear you.
Ron will make a motion. We approve the agenda.
First from Ron. I suppose I'll second it. Can you hear us, Pat? No,
Can't hear you,
he's-
Pat. He says yes.
Okay. All right, we have a motion and a second. All those in favor of approving the agenda, please signify by saying aye.
Aye.
I don't know if Pat can hear us. All right, next is our public comments. 3 minutes per person. Lori, do we have any of those?
Nobody has their hand up.
Yeah, there was a paper copy handed in by Jane. You wanted to speak, is that correct?
Correct. Can you folks hear me?
Yes,
Please hear.
Ken?
Yes.
Perfect. Good morning, everyone. So I am the executive director for the Ashland County Aging Unit right here in the great city of Ashland. And I just wanted to chat briefly about consideration for not cutting our budget for 2021. I understand things are tight. However, a lot of the monies that come through Ashland County, a good amount of it, almost $80,000, is a grant that I work with Clark to apply with, Mr. Schroeder to apply each year. And then there is a little bit of a county match to go ahead and access those monies. With all of that taken,
Okay. All right. Okay.
we have a really, really tight budget. Right now, the contribution that Ashland County helps us out
Okay.
with does not even cover the expense of our meals. Currently, we are serving approximately 160 homes in Ashland County. We do about 2,300 meals per month, and we really are trying to do it on the cheap, if you will. We do depend on our volunteers to deliver the meals. We don't have any additional employees. So we're really running about as tight as we possibly can. So basically, I'm just asking you to take a second look and see if you can help us out at all. And please don't consider cutting our budget, because we are definitely hanging on to every penny possible. So I guess that's all I have for today, everyone.
Thank you. Is there any more public comments?
Pat Douse has his hand up.
Go ahead, Pat.
Yeah, I'm Pat Dose, Bay Area Rural Transit. Most of you know me. I just want to start with saying I hate to be in your shoes. I was finance chair, most of you know, for several years. And I know the tough job that you have to do. And I understand you have to make cuts, but I just have to touch base with you that the cuts that you're proposing for BART at 50%, that isn't just the only money I would lose. My grant, that money is a matching to a grant, and I get, that's only 20 cents to 37 cents on a dollar of what I actually get. So if you cut, for every dollar you cut, I lose, depending on which grant it applies to, I either lose 67 cents per dollar or 80 cents per dollar. So, or 62 cents per dollar, or 87 cents per dollar, 80 cents per dollar. I'm sorry about that. So the cut will hit a lot deeper than just the $6,925 that you're proposing. Right now, all of our drivers are underpaid, have always been underpaid, but they're still willing to work for us for the wages that we provide, and we'd love to pay them more, but I don't ask for more to try and bring that up. We haven't asked for a lot from the county for many years. If this cut goes through, we will have to cut services, because right now I'm working on our budget, and I know how tough this is, and I'm trying to get for a 0 increase for 2021 in our budget, and I'm stuck at right now at 0.2%. So I understand how all that works. I understand the pressure you guys are under. I hate to be in your position. I was in your position for a period of time, but I would like you to reconsider doing a 50% cut with BARTs. Because like I said, it cuts a lot deeper into them grants, because I won't get the grants, the amount of money from the grants if I don't have the local match part. The other things, we're part of 2 tribes, 2 counties, and 3 municipalities, all of which are, according to our charter, which was formed in 1981 by all 7 of them entities, that each one will pay an equal share. So if you drop your share 50%, that opens up the door to all the other entities to cut theirs 50%, which will become a mushroom effect to really collapse a lot of the services much needed that the president and the governor have both said that public transit is an essential service that is needed during these pandemic times. So I understand it's a tough time for everyone. The pandemic has hurt everyone, and I just want to ask you to reconsider the cut. I also wear a second hat. I wanted to discuss one other thing. Is I also chair the the Tri-County Corridor Commission. I see you put in a cut for 50% for them. As many of you know, the Corridor Commission has had a director that has stolen excess of $203,000, leaving it pretty broke. There have been many complaints this summer about the trail condition due to the fact that we don't have the funds to maintain the trail as well as possible. We're working on bouncing back, and even the $3,000 cut that you're proposing to the Tri-County Corridor Commission could drastically impact it, and our ability to keep that trail in the best shape that we can. We're applying for grants. We have grants to do a lot of the trail maintenance, but we also need that additional funds from the 3 counties that formed the Tri-County Corridor Commission to pay for the administrative fees, and to also pay basically all the administrative fees and keeping up with the grants and everything. We cannot hire a director at this time. We are all of us board members that are on that are doing it as a volunteer basis. Basically myself and one other member to run the corridor until we can build the funds back up to where we can hire a director to take over this, because nobody should have to do the amount of work that is being done right now on a volunteer basis. And without that money, I don't know where the corridor is going to end up. Thank you.
Is there anyone else with public comments?
No one else has their hand up.
Thank you, Lori. Seeing no other public comments, we will move on to approval of the Finance and Economic Development meeting minutes from September 24th, 2020. Do I have a motion for that?
Also, this is Marty.
We got a first from Marty
Ron will second it.
and a second from Ron. Is there any discussion? Okay. All those approving it, please say aye.
All right.
Aye.
Aye.
Okay, the meeting minutes are approved. Number 5, discussion investment report.
Packet, so you got a chance to read it. There's no action item here. If there's no questions for this, we can move on. Any questions about the investment report? Okay, thank you.
Pat, did you have a question? Oh, we can't hear you. Yep, still can't hear you, Pat. I see that you have some kind of comment.
Can you hear me now?
There we go.
Okay. My question is, have you looked at any options with interest rates being low like this to invest that money in different ways, or to possibly use that money in a way that can leverage the borrowing, if you will? Because on the one hand, we get a low rate of return on the investments, and on the other hand, we generally pay a higher rate for the money we borrow. Have you looked at any options to try to maximize the investments related to that borrowing?
I have not. The treasurer for the county is the person who's in charge of managing investment, and she would be the one that we'd have to direct that to. She manages the money for the county. So I have not looked into anything else on this.
Okay, thank you.
Is there any other questions? Okay, seeing none, we can move on. Discussion of the 2019 audit report and summary.
Okay. In your SB, you'll see that there's a management letter and then also a summary of the audit from our auditors, in addition to the full 103-page audit itself. I have asked our auditors to come here today to kind of give a general oversight of where we're at from a financial aspect. I will say we want to make sure people understand it's not a job for an auditor to run the financial situation of the county. It's the county's job to manage their finances, to present finances in the understandable and according to accounting principles. It's a county's job to make sure we have the staff to manage the finances and have internal control to separate duties. What happens for an auditor just comes in and gives an opinion that says, we feel that financial statements that we've done, reflect a condition with a level of confidence that it's an honest and open appraisal of what we're presenting itself to. So these are not our financial advisors. They don't do our financial statements, but they, at the end of the year, because we don't have a financial director, we don't have somebody in the finance staff that basically can do the end of the year reporting at this. They do our end of the year financial statement. So it's a little bit of overlap there just because we don't have the money to hire a financial director. And their recommendation, of course, is for the county to hire a finance director. With that, we have Rob and/or Jeff online, and they basically gave, there's a couple things that I noticed that concerned me and that concerned them. We have obviously a decline. The past few years, we've had a mismatch between revenues and expenses. And we've been borrowing money from funds. In particular, we've borrowed over $1 million for our healthcare fund, and we have to pay that back. So that means we have to find another $1.1 million to pay back the general fund. The reason it's important to pay back internal loans is that if we keep budgeting the way we're doing, which is we're not budgeting within the revenues we have, we eventually will have to go to the general fund to balance the budget. The general fund has a balance sheet, but part of that balance sheet is an IOU from the healthcare fund, and that's an IOU, and that's not real cash. So I wanted the auditors to kind of give an appraisal to this, to the financial condition of doing this. So with that, I'm going to turn it over to Jeff or Rob from Whitley.
Hi, this is Jeff. Can you hear me?
Ken?
Okay.
Yes.
I'm gonna just kind of take a quick run through this year's this required disclosure letter and the financial statements, and then Rob's gonna go through some of the trend information. So if you look at the letter that we issued with the financial statements, most of the letter is filled with required disclosures to the county and to the board. A lot of it's the same that there have been in the past, just kind of communicating what our responsibility is and what your responsibility is. I guess as I'm going in, on page 3, it talks about significant estimates that are in the financial statements. We do have, we have a part here about corrected and uncorrected misstatements, and just kind of bring it to your attention that we made several adjusting journal entries during the audit to correct the records. And then we kind of go down to, starting on page 4, we have some disclosures of some internal control weaknesses that we noticed during the audit. As part of the financial statement preparation, that's the responsibility of the county, and we want to communicate to you that we were involved in preparing the financial statements, and we cannot be part of your internal control structure, but we prepared the financial statements in accordance with GAAP, and then the county basically oversees and accepts responsibility for them. And then we also had a comment about the material, a separate comment here about the material adjustments, and that there really should be internal controls in place at the county to make sure the records are properly recorded, properly adjusted, and the transactions are recorded. And then we did have a comment just on other matters of appropriations of funds being over budget. And then another thing that we noticed here is as a procurement policy.
What page are you on, Jeff? Because I'm going through.
Oh, I'm sorry. No, I'm on page 5 of the disclosure letter.
Okay, thank you.
So page 4 kind of starts with at the bottom, there's the financial statement presentation and disclosure finding. Then there's one on material adjustments. And then now I'm into the other matters, appropriations of funds being over budget. And then the procurement policy, in accordance with the uniform guidance on federal grants, there's a required procurement policy that the county is supposed to follow. And, Wisconsin, I believe, is, for the most part, for the state statutes, I think it only really requires bids for construction contracts over 25,000. But the uniform guidance lays out the different thresholds and criteria of when you can purchase things in the open market, and when you can use quotes, and when you need to use sealed bids. So really, you should have a written procurement policy that is in compliance with the uniform guidance. And then the last 2 comments are just some general comments of some, we do have people at Whiffley who help and assist in updating uniform guidance policies. And then we also have people who can come in and help with your cybersecurity assessment and make some recommendations on that. So those last two are just basically informational comments. And then at the end of that letter, of the management letter, we've attached the client representation letter that I believe at the end of the audit, this is a representation letter that Clark and we have Pete and Sue basically signed, confirming that they've given us everything that we've asked for, and basically confirming in writing the things that they've told us over the course of the audit. So if you wanna take a look at that sometime. As far as the financial statements, on page 1 is our auditor's report, where we issue our opinion on the financial statements. And this year we have again an unmodified opinion. And then on page 2, there's some information in the report that's required supplementary information, and some items in the report that's supplementary information. And those talk about and discuss our responsibility on that. And for the supplementary information, we give an opinion that the supplementary information is fairly stated in all material respects in relation to the basic financial statements as a whole. Okay. And then there's a section on the MD&A, starts on page 5, a discussion of some of the numbers. And that's something that's part of the required supplementary information, so that's not audited. On page 14 starts the county's government-wide financial statements, and something, if you're not aware, these are the financial information on a full accrual basis. So you'll notice in here that there's capital assets and debt that are included on here. And for the most part, the governmental funds and your internal health insurance fund are basically reported in the governmental activities column. And then your highway fund is in the business type activities column. If we look on page 17 at the bottom, on a full accrual basis, the change in net position was a decrease of about 1.2 million for the governmental activities, and 430,000 decrease in the business type activities. And just to give you an idea, I went back to the 2012 financial statements, and that net position in 2012 was 15 million in net position, and for the governmental activities. And this year for your governmental activities, you're down to 9.8 million. Something that you're probably a little bit more familiar with, starting on page 19, is your funds on a modified accrual basis. And this is basically a basis that you're probably a little bit more familiar with, and that you budget on, is basically what do we have to spend and what did we spend. So if you look at page 19, something that I do want to point out, in the general fund, there's 855,000 of prepaid expenses. 263,000 of that is prepaid for next year's insurance. That'll be expensed next year. And then there's 593,000 that we have as a prepaid that was for the solar garden project. I think that was with Xcel Energy, where you basically prepaid your electric bills, your utility bills, and then over time you're getting a discount. And basically what we did was that initial payment, I think it was 640,000, recorded as a prepaid, and that'll basically be expensed over time as you realize that savings. The other thing I just kind of want to note also, in your tax certificates, there's 366,000 that's basically for unpaid omitted taxes in the town of Sanborn, where I believe there was some land that was omitted in the past from the tax rolls and was added back. So the tax certificates over time have increased from where they were in the past. So here you can kind of see,
Actually, Jeff, could you give me that total? What is the Sanborn uncollected tax from that lawsuit issue?
you want, well, I just rounded it up to 366,000.
Thank you.
So basically on this statement, we show that your major funds, if funds meet certain criteria, they're reported separately. If they don't meet certain criteria, they're basically rolled up into this other governmental funds. And there is a combining statement further back in the statement if you want to see any of the individual activity of those individual funds. If you go to page 20, this is a reconciliation between your governmental funds and your government-wide statement. So you can see things like capital asset and debt are part of that reconciliation. It takes you from fund balance to net position. Page 16 is your statement of revenues, expenditures, and changes in fund balance. And you can see here the general fund balance went down 391,000. Human services went down 122,000.
What page are you on, Jeff?
Sorry, page 21.
Thank you.
And so, and this is on the basis of the modified accrual. So this is basically what your funds have. It's basically your revenues and expenditures with your short-term receivables and payables recognized as revenues and expenses. And then at page 23, here's another reconciliation that shows your net change in position, your net change in fund balance, and then reconciling it to this government-wide statements full accruals. Page 23 is your general fund budget to actual. And just, it looks like you know, your total revenues were 170,000 more than were originally budgeted. Overall, though, your expenditures were 465,000 more than was budgeted. So you can see at the end, that's where you basically had the net change in fund balance of a negative 391,000. The other thing that I wanted to make sure to point out on page 26, first column is your highway fund. Okay. And then there's the second column is the internal service fund. That's your health insurance fund. And you can see that that has a negative net position of 1,187,000. And that's been building over a period of time. So basically over time, your health insurance claims have exceeded the revenues that you've been putting into that fund. Although, if we look on page 27, this year was pretty close to breaking even. It had a loss of 15,275. And then basically there's the notes to the financial statements. There isn't anything new that hasn't been in there in the past. I will say on page 65, there's a note on the funds that had a deficit fund balance or net position. And then there's the funds that were over budget. So we have the general fund, the human services fund, land records office fund, land conservation grants fund, and the installment loan fund. And then just as also part of the audit, I'll just say one other, starting on page 72, there is a more detailed general fund budget to actual statement. If you want to go through there and figure out in a little more detail of which departments were over budget, that's provided. And then the other thing is part of the audit, we're required to do an audit since the county spends more than $750,000 in federal money, federal expenditures. We do an audit in accordance with the uniform guidance and with the state of Wisconsin state single audit guidelines. So starting on page, looks like page 91, there's your schedule of federal and state expenditures. And then starting on page 98 is our schedule of findings and question costs. So we didn't have any findings related to federal awards. The major program that we tested is 93778, medical assistance. And then here, we didn't have any state findings. Here are the state programs that we tested this year. And then we've also, as part of the Yellow Book report, and we've also included in the financial statements are the finding, again, of the financial accounting and reporting and the material adjustments. Did everyone get a chance to look at those? Or does anyone have any specific questions regarding any of that information? Okay. Rob Ganshaw, who's the partner on the engagement. Are you still here, Rob?
Yep.
He's going to go through some trend information so you can kind of see what's been going on over the past 5 years or so.
So, yeah, I had sent Clark, based on a conversation that Jeff and I and Clark had the other day, he thought it would be useful for the committee to have some visuals of some trends in the fund balance and revenues and expenditures over the past 5 years. Most of the information that we're going to talk about today is related to the general fund because that's the main operating fund of the county and where the vast majority of the funds are raised and spent. And as you can see in the first graph here, the total fund balance of the general fund from 2015 through 2019 has decreased by approximately 29% over the last 5 years. And as you can see, that's not a sustainable model because if we go to, actually, Clark, if you would go to the next slide, this slide shows the detail of your fund balance, and in the financial statements, you'll see that there are various categories of fund balance that are reported. And in the general fund, you have a non-spendable portion of the fund balance, which is basically fund balance that can't be readily turned into cash to be spent. And the next category in the gray is committed. That means that the county board or the finance committee, the highest decision-making authority of the county, has put constraints on those dollars to be used for specific programs or for specific projects going forward in the future. And the only way that those dollars can be used is for those specific items, unless the county board or the finance committee removes that commitment via similar action, whether it's resolution or ordinance. It basically has to reverse the original decision that it made. And then you have the unassigned fund balance in the mustard yellow, if you want to call it that. And that's basically what we look at and the accounting world looks at as the amount of fund balance or reserves that you have available at your disposal to appropriate for expenditure at any point in time. Some people look at that and say, okay, we're going to, apply a portion of the fund balance to the next year's budget in order to stabilize the levy increase or reduce the effect on the taxpayer. as you can see over that span from 2015 to 2019, the non-spendable portion of fund balance has, other than 2017, has increased over that time frame, and the unassigned fund balance has significantly decreased over that same time span. The main reason, and Jeff had kind of talked about this a little bit already, the main reason for the increase in the non-spendable portion of fund balance is related to the increase in tax certificates and tax deeds, which are basically delinquent property taxes that the county has been holding on to since 2015. In 2015, the tax certificates and deeds were right around $900,000. And when you look at that same amount in 2019, tax certificates and deeds are about $1.38 million. And Jeff had mentioned 366,000 of those tax certificates and deeds are related to omitted taxes that the county is waiting to get paid for, related to the town of Sanborn. Also included in that non-spendable portion of fund balance is prepaid expenses, because that's actually money that has gone out the door already for a future expense that won't be turned into cash in the future. So that's, while it's an asset, it's not a spendable asset. And that amount has increased over the years as well, with the largest increase coming in 2018 and 2019, when the county entered into the solar project. It had a cash outlay in 2018, and we'll be recovering that through reduced expenses going forward for, I believe, the next 20 years. I think that agreement is, Jeff, is that correct?
I have to look. I think so.
Okay. I think I saw Laura shaking her head, so I think it's 20 years. Either that, or maybe we're putting her to sleep already and she's nodding off. I don't know. So, that's, we want to point out not just overall fund balance is going down, but the amount available on an annual basis to be appropriated as you need to has been going down significantly over that same time frame. If you scroll forward to the next graph, what we kind of like to do as well is to give you an idea of where does your total fund balance stack up as a percentage of your total expenditures. And the expenditures that we're reporting here doesn't include the amount that you are transferring over to the Human Services Department and the Highway Department for their portion of the tax levy that has typically been levied in the general fund and then transferred over to those two funds as part of their operations. So if you, looking at 2015, total fund balance as a portion of total expenditures was about 47%. As the years progress down through 2019, that amount has gradually slipped where in 2019, your total fund balance compared to total expenditures in the general fund is about 31% of total expenditures. If you go to the next slide, Clark, I think the more telling or the more important graph for you to focus on is what is your unassigned fund balance compared to total expenditures in the general fund, because that's the amount that you can use to apply towards the next year's budget if you need to. So if we look at 2015, the unassigned fund balance to total expenditures, again, not including the transfers out, was about 35%. Your unassigned fund balance represented 35% of your total expenditures for that year. So you were able to basically had a cash flow position of about 1/3 of your full year expenditures. As the years have progressed and we get to 2019, your unassigned fund balance as a percentage of total expenditures is 8%. If you look at recommendations that are out there by the Government Finance Officers Association, which is a national organization of finance officials, they, at a minimum, they look at a municipality's unassigned fund balance in the general fund, and they say that, as a minimum, it should be 2 months of revenues or 2 months of expenditures, whichever appears to be the more, how do I want to say, the more consistent base throughout the year. So if your expenditures are incurred on a more consistent basis than your revenues are, you would like to compare that to your expenditure stream. If we compare it to your expenditure side, the $962,000 is a little bit over 1 month's expenditures in the general fund, not taking into account the amounts that get transferred over to your human service department and your highway department. If you compare it to your revenue stream, it's less than 1 month of your revenue stream. So with that being said, and I think that was the part of the impetus for Clark to have us talk to him, number one, for budgeting going forward, as well as coming in and talking to you, is, going forward, how is there going to be a way to be able to improve that unassigned fund balance as a percentage of total expenditures? Or how is the county going to be able to, minimize the negative trend so it doesn't have to start doing operational borrowing just to meet the cash flow needs of the county on an ongoing basis during the year? So that's the purpose of this graph, is to show you basically how many months of expenditures you have available at December 31st, 2019 available to you. Another graph with trends that we put together relates to, okay, what's the total general fund revenue stream compared to the expenditure stream, and what has been that trend over the past 5 years. On its face, looking at this graph, you would say our revenues are trending over our expenditures. So, why do we find ourselves in a declining fund balance position, and why would we be having issues? The item to keep in mind here is it just includes the expenditures. It's not including the amounts that are also being transferred over to the Human Services Fund and the Highway Fund. And in hindsight, what I should have done, I should have also included a graph on that, and I will put that together and share it with Clark, and he can share it with you as well, so you can see that complete picture there. So you can see what the effect is of those other funds taking a portion of the overall tax levy for their operations has on the general fund itself. But when you look at the overall trend in revenues from 2015 to 2019, the revenues increased approximately 4.7% over that time frame. But if you look at the expenditure change over that time frame, it's about 9.8% that the expenditures increased. So, it's, as we mentioned before, it's not too hard to see how your fund balance is going down if your expenditures are increasing at a rate faster than your revenues are. And a lot of that has to do with some unfunded mandates that come from the state, as well as the limits that the state puts on not just counties, but all municipalities as far as what they can raise their tax levy by each year. If you're in a county or a municipality where your net new construction is minimal or stagnant or negative, you're really put behind the 8 ball as far as what you can do in raising taxes. And we're all aware of the challenges that human services departments, especially in smaller and more rural counties, are having with mental health issues, as well as drug addiction. Methamphetamine has been killing rural counties, and the money to operate those programs has to come from somewhere, and it's not being funded adequately by the state or federal government. So with that in mind, while it's not included on this graph, I did take a look at the Human Services Fund too, just to give you some guidance there. When we look at the expenditures and revenues for that same 5-year period, expenditures have gone up 31% in the last 5 years in the Human Services Fund, and revenues have only gone up 27.8%. So there again, that 3.2% has to come from somewhere, and the more that Human Services has to take, they've been using fund balance in the Human Services Fund, but at the end of 2019, the Human Services Fund has almost exhausted its unassigned fund balance as well. It has about $30,000 in unassigned fund balance, whereas in 2015, it had about $1,040,000 in unassigned fund balance. So, the county's been doing what it could to minimize the effect over those years by using that fund balance. But, at this point, as everybody is saying, there's hard cuts and hard decisions that are in front of you. The last item that I have, and Jeff and Clark had mentioned it briefly before, is some trend information on the self-insurance fund. You'll see in 2015, the fund had an exceptionally high year for claims at about $3.5 million. Came down a little bit in 2016, at about 3.4 million. A little bit more again in 17, and 18 even a little bit more, and then it just increased a little bit in 19. In each of those years, though, the revenues that were generated to pay for the benefits for the county employees, and it's a combination between the premiums that are being paid by employees and the portion of the premium that is being paid by the county for that insurance, has been behind what the claims paid were. And Clark, if you go to the next slide, I think it really points out the drop-off year, and we had mentioned this before. In 2012, kind of broke even. 2013 made a little money. 2014 lost a little bit, but then, like the previous slide showed, in 2015 there was a bad year, claims compared to revenues generated. 16 added to that negative because expenses outweighed the premiums that were generated. Same in 17, a little bit more in 18. 19 kind of leveled off. But from that trend, it almost looks like there should have been an adjustment in the premiums that were either being charged to the employees or the amount that the county was kicking into that fund to pay for the claims. Now, Jeff and I and our Eau Claire office have only been working with the audit, and I'm not trying to make excuses or anything, basically since the 2018 audit. So we're not 100% sure, what decisions were made back in 15, 16, and 17. If it was a budget issue and the dollars weren't there for the other funds to be paying a higher premium amount into the self-insurance fund to cover the expenses, or if there were changes made to the plan that either, what am I trying to say? If the benefit was better back in 15, 16, and 17, and changes have been made to the deductible levels and all of that kind of stuff now, where, in 2019, the plan is paying out less based on the premiums that it's generating, or what the impetus really is there. And this is where Clark was talking about, there's a deficit there that needs to be, recovered or paid back in some fashion. If you, in looking at the financials, at the financial statements, and Jeff had kind of mentioned it before, at year end 2019, of that 1,187,000, that's a deficit net position, the health insurance fund had borrowed $942,000 from other funds within the county to pay those claims. So because the county pools all of its cash together, it basically is getting used out of the same pot. It's just being accounted for in the different funds.
Okay. Are there any questions on the audit from the committee?
My question would be, this is Pat Kinney, as far as rating for borrowing in the future, what does this look like now versus where it was in the past, and what would your recommendation be if we want to get ourselves in a better position to have a higher rating for borrowing, which means lower interest rates, obviously?
I think if you were to go out to the market right now, and they would look at the information that's out there as far as your unassigned fund balance compared to total expenditures and budget expenditures, and the trend history in the fund balance. And I don't know the overall economic situation in Ashland County, because they take a lot of those demographics into account as well. I'm thinking that your rating, obviously, it would be lower, as far as being able to increase that rating. And I think Clark has an item for discussion on the agenda later, is somehow, the county is going to have to develop or find additional revenue streams in order to support the operations of the county as a whole. And what form that takes, I don't know, but Clark is trying to do what he can right now within the revenue cap by looking at some of the exceptions that are out there with the borrowing, and then being able to, because that's outside of the normal levy limit calculation, you can use that as an exemption on there in order to get more tax revenue for the county to operate with. However, I don't know that continually borrowing more and more money on that exemption to be able to increase your tax levy for operations, is a sustainable solution. and I know that Clark had mentioned in the past that there was a committee or two that had batted around the idea of a wheel tax to potentially help with, funding maintenance or construction on county roadways to potentially minimize the tax levy effect that the highway fund has on the overall general levy. There again, it's not the most popular thing to do. The other option is, are there services? Do you do a poll of your county constituents and find out, are there non-mandated services that the county is currently providing that, county looks at reducing or cutting back on, or seeing if there's a private entity out there that already currently does something like that, or going into a public-private partnership on some, any of the services that the county provides that may lend itself to that. Those are things off the top of my head that I can think of.
And then one more question. As you look at other counties that you've worked with, is there anything that you've seen in those counties as they've made decisions related to their finances where things have worked out well in terms of direction to address budget issues, or things that are not working out well that you might caution us in terms of direction to address a situation like this?
Well, I think what really, how do I want to put this? A lot of the other counties that I have worked with, we don't typically see consistent over expenditure on the budget in the general fund on the expenditure side of the budget. When I was looking and putting some numbers together, and it was related to the first slide. When I was looking at where the county was budget versus actual in each one of the years 2015 through 2019, in 2016, the budget on the expenditure side was overspent by about $528,000. Now, I don't know if that's purely just a case that there were no budget amendments made to appropriate additional funds that had come in during that year, but but that's a pretty big miss on the expenditure side. In 2017, there was a net overspend budget versus actual of about $462,000. 2018 was a little bit better. It was $32,000, and then in 2019, as Jeff previously had mentioned, it was about $391,000. So while you're putting together budget or balanced budgets, the expenditure side of the budget has consistently, the actual expenditures on a yearly basis have outpaced what has actually been budgeted for those particular years. So I think you know, number one, when the budget is being put together, either it looks like one of two things. Either the budget that's being put together isn't being based on, previous year's expenditures, or there's just always items that are coming up each year that are requiring the county to overexpend its budgets in, multiple areas within the general fund. So I think some of it comes down to, just good old fashioned, okay, is when you're looking at expenditures, and even at the department head level, did I include this expenditure in my budget? If not, do I need to make it? Can we operate without it? And, just getting back to what I would call the basics of sticking to the budgets that are being put together. And, if it's big spends that they say, well, I forgot to put it in my budget, I should have put it in there. Well, there's hard decisions that need to be made. Then is, can we afford, or can the county afford to make that expenditure? Are there other areas within your budget that you can go without? And I understand the vast majority of budget's probably going to be salaries and benefits. So that gets to be a hard choice too when you're looking at cutting positions, because you have to be able to provide services if you're going to have the services.
Thanks, Rob.
I have a question. The weird loan that we were taking out to balance our budget that Clark corrected with the DOA, does that have to do with where we're overrunning our budgets?
You can correct me if I'm wrong, Clark, but I don't believe so, because that's being budgeted as part of your tax levy for that
Yeah,
current year.
that's under debt levy, so that's not under the general fund. So that's different.
Okay,
But it's being included in your total tax revenue that you're generating, of which you are appropriating expenditures related to that 500,000 or 520,000.
thank you.
Okay, thank you.
Is there any more questions on that? I want to thank you, Rob and Jeff, for your very thorough reporting and answering our questions. I really appreciate that.
Not a problem. We're always, we'd rather be in on the front end than on the back end. And, I would suggest that, and I know that Jeff in the past didn't have us speak about the financial statements to the finance committee or anybody, but I would suggest making this an annual event at the end of the audit.
I agree. Thank you.
Yep.
And we don't need any motion on this one, correct?
Correct.
Okay, we can move on to
Have a great day.
Thank you. Discussion or action on the Wisconsin Utility Tax Association request for legislative change to utility payments to local governments.
Okay, so this, I won't read through this. I'm assuming the committee has all read through the packet, but in short, for the audience, the counties that have utility generating facilities within them don't collect property taxes off those utilities. So in this case, we have a utility generating here in town, and we don't collect property taxes off of it. What happens is there's a utility fee that goes to the state of Wisconsin. The state of Wisconsin distributes that back out to municipalities and states within the state. Back when this arrangement was set up back in the 60s or 70s, the state would return 80% back to the local municipality and keep 20% for administrative. They now have basically moved 80% to the state that they keep and 20% comes back to municipality. Ashland County gets around $200 and some odd $1,000 from, in lieu of property taxes, from the power plant here. And what we're asking for is a resolution, which you have read, which will go to the county board on the 10th, which is basically just asking the governor to put into the budget to provide a fair, more equitable return on utility tax collections to counties and municipalities as utility aid. And so this is kind of the letter from them. And then here's the resolution number 102-2020-1364. Part of basic state funding for equitable return of utility tax collections to counties. And with that, I would seek a motion to approve resolution R10 2020-1364.
This is Marty beat that.
Marty made a motion to do that.
This is Pat, I'll second.
Okay, we have a motion and a second. Is there any questions on this? Seeing none, all those in favor, please say aye.
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 Aye. And any opposed? Okay, motion carries. The next is our ideas for new revenue to support county operations.
Yep, so the last meeting you had talked about the need to focus on the 2022 budget, since we really can't do much with 2021. And we basically have started a spreadsheet, basically, that people, the committee can work with the administrator on and work on some different ideas, and who has time to research them and look at trying to generate new revenue, if that's a possibility for the county. And you know, some of the other things that we may consider, if the county's not amenable towards raising new revenue, is, I think one of the things I would recommend is, as we start developing the 2022 budget, I'm going to start early this year, because I think we should probably have the departments come back with maybe a 3 or 5 or 7% decrease in their levy funds. And what would that mean to operations? Because I think those are some of the ideas for the county board to consider, which is, you know, revenue and expenses as a combination to try to balance the budget, because we need to get back to a position of not even a balanced budget. We need to get back to a position of putting money back into our general fund, paying back our $1 million loan for the healthcare, and generating more money just to leave at the table, so that we are not at 8% of our unassigned fund balance. My research has said we need to have 25% as a minimum recommendation from the Wisconsin Counties Association. So we need to go beyond balancing the budget. We need to come back to generating more money that we can basically save the county, so that we're not going to continue down this road of unsustainable budgets. The other thing I think that we would want to consider, and we'd want to consider this early in the year, is a levy, basically a referendum to increase the levy in April. If the committee was so supportive of that, we would basically move forward and try to develop a plan for an April election. And the reason I would recommend an April election on that is because if it is voted in or voted down, that would basically give us time to adjust the budget to figure out what we're going to do. And I think having excuse me, having the departments come back to us in early 2021 with, 3, 5, or 7% decrease in levy would basically help the citizens and the board decide, is this where we want the county to go? And just for, so if you were to decrease the sheriff department levy by 5%, that's probably $250,000. So that's going to affect how many hours you're going to have on the road. That's going to directly affect services that we would have to the county if we decrease that budget. And I think we need to weigh those issues as we look at a referendum. If the county board is supportive of that. If the county board is not supportive of that, it's a pretty simple scenario of basically just, decreasing the budgets and decreasing the services. So I guess this is just a discussion point, and this is in your packet for you to read. And I would encourage you to, work on these issues, because I do the best I can, but you can see we have a lot of issues in front of me. And I welcome any help that you can concerning adding to this list or researching this list if it's a non-viable solution.
Can I speak?
Go ahead.
I agree with doing a referendum and the planning, and for the reasons that you suggested. That way it's in the hands of the voters on this. And I realized 2 years ago it didn't pass. And I think 2 years ago, there was talk of a new law enforcement center or justice center for $25 million. It was in the paper. And I think at the time, a lot of people said, no, we don't want to spend $25 million for that. I think if information is provided to the public and it's articulated and over a period of time for questions and answers, and the ask in terms of the levy, the amount, and for however many years is reasonable and well defended and justified in terms of the services the county provides, then I think it has a reasonable chance of passing. And I just don't think that those things happened last time. Also, there was the school district referendum, which a lot of people weren't happy with that it passed, so it was perhaps bad timing. But the referendum would distribute the burden for increasing revenue equitably in direct proportion to all taxed properties. And to me, that's more equitable than targeting certain groups of people, through other ways of revenue. It shares that burden in direct proportion. So I would support that referendum and a very strong effort to articulate those reasons, including information that was shared with us today, so the public has that. And in terms of other things, the chair of this committee is with Bad River, and he mentioned in our first finance meeting this year that there are some grants that he can apply for, or Bad River can apply for, that the county can't. So I would have a conversation with him to see if there's anything that they could provide or apply for that would help the county and Bad River. And the other thing is our AEDC executive director has done an amazing job of bringing grant money in. I would suggest a conversation with her. I know she's more than busy, but to see if there's some grant opportunities she may be aware of that she could work with the county, and you'd have to talk with her about how that might work into her workload. But she's done an amazing job on grant writing and bringing money into the county.
Okay, any further discussion on our path going forward for kind of a dual thing, which is researching revenue and then basically coming up with contingency plans if we don't generate new revenue, and then we can kind of hopefully weigh that out at the board level and the citizens can weigh in on that.
I agree with everything that Pat said, and I'd like to add to that also by our auditors of polling our citizens to see where is their purview, what are the services that they want us to continue to supply. Asking them as Pat said, with the right information to them, that these are the things we're going to be able to do and these aren't, and we are looking for other streams of revenue, but we don't have all of that right now. And with the overspending that we've been doing historically, this should have been put to the citizens better than evidently it was last time. We've kind of put ourselves in this position, and I understand about the unfunded mandates because I hate unfunded mandates as a policy person. But we have to just lay it all out for everyone. That's what we're here for, is to show people what we've got, what we can do, and where we're looking at, so that way we can continue to provide them the services that they need.
Well, I think one of the things is, I don't think that we can, the citizens can't vote on basically saying they don't want mandated services. That's a state issue. So we can't say, I don't want to have a child support division, or I don't want to have a jail, or I don't want to have a
That
county.
was not anything that I was saying. I'm just saying where their priorities are.
Yeah, I know. And so what I'm thinking, Laura, is we probably, before we do that survey, we probably want to come up and say, what are the non-mandated services in the county that we provide, if any? I'm not aware of any. And then, but also, what would you like to see? Maybe there are citizens who want to see other non-mandated services. Maybe there are citizens who want to raise taxes to have a park, a county park, or maybe they want to do something, something I'm not aware of. So yeah, but I think the first step in that survey would be to figure out what are the non-mandated things that we do, and then basically, if there is any, and then basically say, what else would you like the county to do? So.
Agreed. And we don't need a motion on that. Any more questions, anyone? Okay, we're to our budget review and recommendation.
Let me load this up. All right, so bigger screen. Big enough document, it's pushing the computer here. So at the Polk County Board meeting during the budget review process on October 6th, no specific suggestions were offered to balance the budget outside of a general consensus to tighten our belts. And I will reiterate for those in the audience that the county board has never had the opportunity before to weigh in on the budget. The county board usually, traditionally, would just see the budget after it's been publicized in the paper at the public hearing, the second Tuesday of November, to approve. And so, this is a new, I'm trying to get the county board more involved in this. I want the auditors to speak. I brought them in. I brought the county board in to speak about the issue here. And so, but it's new for the county board. So for them to weigh in on a policy issue to say, we're not interested in this. Yeah. There, not so much glare for you. So anyway, as such, basically, I'm just bringing the budget back to this committee in order to basically give a recommendation to the county board for what they want the budget to do. I'm going to quickly just go down to the timeline. So again, we're at hard dates. So this is pretty much the last day we can do this. We need to send this to the paper on the 19th, on Monday, and then it's going to be published, and it has to be published for so many days before the public hearing on November 10th. So today is the last day to make any changes to this budget. I have talked to the bank. I'll go over this shortly with them. So going back to this letter, we basically have two versions of this budget. One budget, we take $193,000 from the bank, and this is out of that unrestricted fund balance. So out of that $900,000, we're going to take either $193,000 or we're going to withdraw $257,000. And the only difference in there, so this does not affect the tax rate, because that basically, it doesn't change. We're just basically taking more money out of the bank. We have an adjustment of $51,000 since the last time you saw this budget. The Department of Transportation is issuing a projection, that's just what it is, a projection that they think gas tax revenue going back to municipalities and even the county will increase in 2021 by $51,000. So you can see that right here. And so what we did was we decreased the contribution of the Highway Department general levy amount from 500 some odd thousand down to, from like 590 some odd $1,000 down to like 543 or something like that. And that basically, that money just stayed in the general fund, which is used to fund general county operations, which in turn decreased the amount of money that we have to take out of the bank to balance the budget. So it's just a flow through basically. The debt levy is same as presented to the full board, with the exception, if this finance committee wants to approve the debt levy as is, I'm going to add $7,875 to it. So one of the, in order to take out the debt levy loans, they need to, there's interest. It's not a free service, obviously. So we have to pay the bank to borrow this money. So in talking with the bank yesterday, if we take out around $1.8 million at 2.5% interest, that would be basically for 63 days, that would be around $7,800. We're looking at, for the auditor standpoint, we had just been taking out a short-term loan. We're looking at taking out a 366-day loan in order to qualify it as long-term debt. So we basically would take out the loan on December 8th, pay it back in 2021 on December 9th, let's say. So that'd be a 366-day loan. But because we don't need to accumulate the interest, we would pay it back as soon as we get our tax revenues or our tax payments coming in January. So we pay it back like in 63 days, basically like on February 8th or 7th or something like that. So that basically, because there's no need to keep paying on that loan when we have the money to pay it off. Given the time frame, I think I talked about that. Finance Committee needs to approve the budget today and make a recommendation to the full county board for the public hearing on November 10th. Once a budget is set by the committee, a resolution will be drafted, presented to the full county board for debt levy in November. So with that, I'll just briefly go through these two different budgets here. This is, again, where does your money go, version 2. And so this has been adjusted with the $51,000 difference. Out of the proposed $100,000 home, a $100,000 home would pay $672 per year. Of that, $29 would go to public safety. Highway would get $367. General government would be $630. Education and recreation, $1.77. Conservation and development, which has the forest land, the forest revenue coming in, actually sends money back to the county of 92 cents. The debt levy would be $11.93, and health and human services would be $15. So in version number 1, and again, the only difference is basically how much money we're taking out of the bank. Version number 1, I broke down what the general operations are, or what the budget is broken down by category, and our general levy. As you're well aware, with the levy limit laws, we really can't increase the general levy beyond a net new construction in the county. For this county, it's like $22,000. So when you take that general levy, we have around a $21 million budget. Your general levy is $6.6 million. Out of that $6.6 million, 900,000 goes to general operation. 4.4 million goes to public protection in the sheriff's office. 2.2 million goes to health and human services. $500,000 to highway and airport and other transportation, education and recreation, $250,000 conservation, land development, 158. And so that's where we get our $6.2 million. So this is the budget with $193,000 out of it. That would basically incorporate cuts to BART and Office on Aging and Northwest Regional Planning Commission. And we get down to the same levy here of $6.72. And this is our capital improvement levy. And I had forgot to add in that $7,000. So if we approve this, I would like the committee to approve 1.807, and then whatever that number is between 640. Anybody have a calculator?
7,000 what?
So 1.8640 plus 7, let's just say 7,900, just to make it even. $7,900.
We were at 1,808,540.
Okay. So that would be what we would want to publicize, and we would just add that in as an interest line item to do that. And then here's your detail of the version number 1. And then here's your detailed version of version number 2. Here's your general version number 2. Come down to $257,000 of transfer from the general fund to balance that budget. And the outside contributions is really the only difference we have here. And I'll go through that here. So here's a request for from the outside entities for 2021, a percentage and a recommendation basically. And if we want to keep them, where they're at, we basically just go with version 2. We did make a couple changes in here. Hang on, let me get this a little bit lower here. The Northwest Library, that's the library distribution, that we had been paying for that out of the general levy. And of course, the general levy is the whole exercise is about, can't raise. In talking with the director over there, she has said, we are the only county that uses general levy for that. Everybody basically is using the library levy. So we moved that to library levy, and you'll see that on the levy worksheet. In addition, the airport had requested $87,000 up from, I think, $20,000. And we're basically moving $46,000 to debt levy because that's for capital improvements out at the airport, and then their operations is 41,000. So with that, if you want to approve the budget version number 2, I would seek a motion to say, seek a motion to say approve budget version number 2 with the addition of the $7,900 in interest expense for an overall debt levy of 1.808540. And I'll take questions.
Clark, this is Pat. Regarding versions, I would support 2 because some of those community contributions, such as BART, that one I'm familiar with from time on council. If you cut that as proposed in version 1, that creates real issues. And I think Pat Doust was actually understating the issues that would create. And the economic development with the director there, the money that she's brought in, not just with grants, you know, for example, getting the Evergrow Daycare Center going, and then other things that she's been working with pandemic relief has certainly brought money into the county. And there's some others that I have concerned that we don't fully understand what those cuts would mean. So I think that's an area that we need more research on to understand the implication of those cuts, because in many cases it's a number of entities supporting that and would create problems. My question, main question is this though. Back in the summer, the Finance Committee voted for a 0% increase on taxes, and we're looking at a 4.37% here. How did we go from the Finance Committee direction on 0% to looking at this? And why is there not an option for a 0% presented?
Because I just couldn't balance the budget that way. Basically the decrease of about $400,000 in revenue. So you have a couple $100,000 decrease in forestry funds. We had $115,000 transfer from Health and Human Services to balance. Plus the committee does agree with a $100,000 decrease in sales tax. So that's a $400,000 decrease. And given the pandemic and the time frame to try to put this together, it's my failure, it rests on me. I'm not able to figure out how to eliminate $400,000 from the county, which basically is just employees. I can't figure out how to get rid of that many employees. And so that's why I'm basically making a recommendation of this, because I don't have the time frame, I just don't have any other way to figure out how to cut $400,000.
Well, what happened with the city of Ashland starting in 2010, in a very similar situation, very parallel to this, the initial cuts came from reducing capital improvement expenditures for the first year, and then sorting out what was really needed for capital improvement going forward after that. And so I'm looking at that capital improvement list, and there are certainly things on there where I'm curious if we couldn't put those off for at least a year, or perhaps do without them to lower this tax increase.
Well, the majority of your capital improvement goes to the highway department.
Yeah.
$405,000 for equipment and $620,000 for road construction. The road construction is increased because when we look at our 5-year construction plan, I increased that $100,000, because if we don't increase it $100,000 this year, that will be a deficit, of course, and we will basically have to borrow $500,000 in 2025 to basically get to there, in addition to the $520,000. So you're basically putting in a $1.5 million debt levy for the highway department in 2025 by not including $100,000 in the road construction every year. So if we go down line by line here, these top vehicles are vehicles which we already own. And I'm basically just I'm trying to save general levy dollars for salaries, because that's what I'm trying to save them. If we put that in there, we're just gonna have to take more money out of the bank because we already own them. Security cameras is a recommendation from the security committee for the courthouse. We have polls. That is not a mandate, but that's a recommendation from the security committee to increase security for the courthouse. We don't have to do that. Highway, I mean, it's not a mandate, but again, you're gonna really put the highway department behind the 8 ball if you decrease that. Health and Human Services, I want to buy 2 cars because I think I've talked about this before. It scares me that we have Health and Human Services people transporting individuals, be that children or clients, in their own private vehicles from a risk management standpoint. I absolutely think that's one of the worst things to do from a liability standpoint. And so they need to be in county vehicles. The boiler needs to be replaced. The Sanborn building loan and New Horizons loan, we have to pay those unless we're willing to sell them. And those loans basically, in my research, it doesn't look like they were budgeted. So when I think about the previous over expenditures, let's call it unallocated spending, I think that $134,000 right there is part of it because nobody budgeted for it before. I think they just paid for it. Again, trying to balance the budget, and one way to balance the budget is just not to report expenditures. The Sheriff's Department, I guess, are you on, Mr. Knapp?
Yes, I'm here.
All right, would you speak to the items that are on the screen there for the Sheriff's Department?
Certainly. The $76,000 is actually an amount that we owe from a previous bill from dispatch radio replacement that we did a couple of years ago. That needs to get paid for sure. If we don't pay that, obviously the vendor could sue us for it to get that money. But in addition to it, they will stop servicing us. So if we have a problem with the 911 system or the radio system, they would fail to come here to correct the problem. And of course, that would be a monumental problem for us. The taser issue is also a concern for us. Our tasers are very old. Some of them are malfunctioning, including mine. Obviously, the taser is your first option if you have the opportunity in a situation. You hate to not have that tool on your belt and have to go to a firearm instead. So, that's a concern for us as well. If you look at squad cars, we have, I believe, 24 vehicles in our fleet. We're only asking to replace 2 a year, which, I mean, if you do the math, you'd say, well, we're replacing cars every, 12 years. Actually, the admin vehicles we keep a very long time, and we're trying to replace our patrol vehicles about every 5 to 6 years, depending on the maintenance issues that they start to have. But we're keeping our patrol vehicles longer than any department I'm aware of. And if we don't have a replacement of at least 2 cars, then the following year we're going to have to ask for 4 cars. So, I mean, it's not something that's easy to catch up on.
And then the fence around the North Tower, that's one of our repeater towers, is that correct?
That is correct. And through emergency management, we were able to get a grant to put a generator and propane tank at that North Tower site. That's kind of our main communications tower for the whole county. And when we have all of that new equipment installed in the spring, we certainly want to secure it because we don't have any visibility on that particular site, nor do we have any cameras or anything like that because of its remote location. So we want to get a fence around that to secure it.
The $14,000 for the courthouse Radio Connect, can you speak to that, Jim?
That one I don't recall offhand. I think that was something that our IT department was working on. He's not in the room with me right now, but I'd have to discuss that with him.
Yeah, so that's basically Chris Kupchak basically is recommending that we utilize because it would basically allow quicker response time in the courthouse in a active shooter or a security issue. So right now, if there is an alarm button on every phone, but what happens is when it goes to the dispatch or it goes to officers, it just says the courthouse has an issue and you have to go to each phone and all 3 floors to figure out where is the problem. This would basically say it's in this person, this phone, this extension has an emergency situation, please respond, please send help. So again, that's just a security issue. That's not a mandate. You don't have to have that. We're just looking to increase the security of our staff. As a society looks like it devolves sometimes. So the rec officer, Jim, would you be able to speak to the rec officer?
The rec officer program is actually works through a grant process through the Wisconsin DNR. There is equipment that we tend to buy almost every year. Much of the equipment is reimbursable. I would say almost all of it. Looking at, the purchase of snowmobile, ATV, UTV, trailers, all of that is reimbursed by the Wisconsin DNR through a 5-year depreciation program. So we spend the money now, we get the money back over the course of 5 years. So it's generally a cost neutral program.
Okay. Land Conservation has a truck. Mary Jo is actually in the audience here. Mary Jo, if you want to speak to that.
Sure, we're looking at replacing a 15-year-old truck that we currently have that's almost completely rusted out. This year in 2020, we replaced a 19-year-old vehicle that had holes in the floor. On that truck that we'd like to replace, the steps have rusted out. We've had increased maintenance on it. And basically, the staff person that uses that is a wildlife damage coordinator that's fully reimbursed by the DNR. So this employee pays the county a year of $4,500 to lease that vehicle. So we would be able to generate revenue on it. But once again, it's a replacement of extremely old vehicles that are used on a regular daily basis.
The airport, I really can't speak to that. They pretty much give that, and they say that's in the city's capital improvement budget. I can't speak to that. I don't think since we're co-owners of it, I don't think we have an option of not doing those repairs. That's something that would have to be researched. And then the data processing are basically computers that normally would be put into the general levy, but when we have $400,000 decrease in the general levy, we're putting the normally expected computer upgrades into the debt levy in order to save general levy for staff and operations. The converted 8-year loan, the $286,000, that basically is your line of credit that you have been using for a few years. And that's the thing I cleaned up with the DNR. You have 7 years left to pay on that. And again, so that's not much you can do with that. Capital improvement ends up being 1.984. I'm moving $184,000 out of two funds that are not being utilized. And that goes back to that investment report that you saw earlier on in the thing. Ends up with our total debt levy of, with the interest, 1.808540.
And then before we go further, I'm looking at what would be page 2 of, I'm looking at version 1, but it's the same thing on the other one. I just want to make sure that what I see here, I'm clear on. So towards the bottom, it says proposed 2021 total levy per 1,000. We're going from 644 to 672, and that's per 1,000. And then above that is the change in the equalized value. That increased by nearly 3%. So on that proposed 2021 levy per 1,000, that does not take into account what a person will see on their tax bill due to the increase in equalized value. Is that correct?
Could you ask that question one more time?
So the equalized value went up nearly 3%. So let me ask it the question this way. Suppose a person has a $100,000 property. They were taxed based on $100,000 last year. The equalized value goes up 3%, so now we'll go to 103,000. So the proposed levy per 1,000 is increasing by 4.37%, but that $100,000 property is now going to be 103,000 based on the increase in equalized value. So the number of thousands per property is increasing by 3%, plus the increase per 1,000 is the 4.37%. So what I'm wondering is, are we looking at a tax increase on the tax bills of something over 7%, or are we looking at 4.37?
Well, your $100,000 house would have a $28 increase in taxes, according to this. If your tax, see, not every house is reassessed every year. The issue is we don't increase taxes on reassessed house so our general levy limit. So when you go back here to this, the levy limit law, here you have your increase in your equalized value. Net new construction is the only thing that you can increase general levy on. So in this case, your general levy actually decreases by 3% because you're basically taking the equalized value and you're taking your maximum amount of general levy limit law, which is limited by net new construction, and you're redistributing that over the increased assessed value. So some properties are assessed, some properties aren't reassessed. In this case, if there was a municipality that reassessed a bunch of properties, you would see that increase in the overall equalized value of the county, but you can't increase your general levy limit. So therefore, the general levy actually decreases from $5.43 to $5.29. Reciprocally, on your debt levy, you're basically going with the same equalized value. In the debt levy, there isn't a limit from the state. The debt levy is whatever the county board decides it is. And so you basically have your equalized value go from $1.01 to $1.43. And then when you add those two together, you end up with going that $6.44 to $6.72, a $28 increase on a $100,000 house.
Isn't the point of the equalized value to keep basically as fair and even playing field as possible on taxes, because we don't reassess every year, you know, in counties and cities? So the number of thousands that a person's paying on, isn't that increasing by, in this case, about 3% for the following year?
Well, so if somebody has a $100,000 house and it stays at a $100,000 house and it's not changed in the equalized value, they'd have a $28 increase.
Right. But we do have a 3% increase in equalized values.
That individual house is assessed by $103,000, then they would be an increase of that whatever on $103,000 is, and we can do the math on that. It would be more than $28. It might be in $20.
So that's kind of my point or question or observation here is, as we look at this proposed increase of from 644 to 672, it looks like a 4.37% increase, but because of the increase in equalized value, a person's actually going to see 3 more thousands that they're taxed on for every $100,000 they have in their property.
It also is reassessed, yeah.
So the tax increase that people would see on their bills is going to look like something more in the 7% range than something in the 4% range, because their property, because of equalized value, is going to have a higher number.
I would suspect, yeah, I don't know. It based on each individual property.
Yeah, so that's my, well, both question and concern here. And then on the proposed 2021 total levy limit per thousand, it shows 104.37 there. And when I took the numbers 644 and 672, I came up with 104.3478. So I'm wondering where the 0.37 comes from as opposed to the 0.3478. I was wondering if that was, I don't know if it's rounding error. I couldn't find something that would lead to that rounding.
Well, I'm sure part of it is, yeah, this is just an Excel formula. I'm sure part of it is how many places we're rounding the 644 and 72 with the $1.2 billion and the proposed tax levy. I'm sure somewhere there's a rounding error. The only number that really makes a difference, Pat, would be the $6.72. That's the number that gets sent to the state.
Okay.
The percentage is just for your edification.
But Excel keeps quite a few places internally when it does the computations. And so I was wondering if Excel did that and it's based on some earlier numbers where I didn't track down it, or if someone did it on the calculator and penciled it in. Okay.
Clark, I have a question on one of our outside entity payments. I know we pay out to the county fair, and there was no county fair this year, correct?
That's correct.
So did we transfer them the total $20,000 for this year?
I believe we did, because when you set the budget for 2020 last fall, when we got into the budget, I'm assuming they just sent the money to them. I mean, so I'm assuming they sent it like in January or February sometime. Okay, the budget, it was a budgeted expense, I'm sure they sent it.
Okay, so they should have the $20,000 sitting there then, correct?
That would be my assumption. I can't double check on that. I'd have to have somebody in accounting verify that, but my assumption is that they don't wait halfway through the year to pay that. They on the way the first part of the year.
Well, I understand it's only $20,000 in a 400,000 pot we're trying to look at, but if we've already paid for this year and there was no county fair this year, I don't see that we should pay again for another county fair and have $40,000 sitting there. I mean, we budget the 20,000 for when there is the fairs and the exhibits and such, but that I feel we could cut that piece out for next year if they've got that $20,000 sitting there from this year.
Yep, we can do that. We would need the consensus from the finance committee on that one issue, and then we would adjust the budget before publications to reflect that direction.
The 20,000 that's there this year, is that supposed to go back to the general fund this year and then in this budget then be reallocated for next year? I mean, this is an accounting detail that if it's not expended this year, it remains at the county and in the general fund goes back to that fund. And
Yeah,
then, but then this budget needs to have a line item for it for next year. So, but it, the same net effect. Laura says, let's keep the money this year. It wasn't expended. But I think we need to budget for it next year. Otherwise it's not in the budget.
So the county fair is not a county operation. That's an outside entity. And so because of that, we physically write a check and send it to them. So that's a nonprofit organization, if I remember correctly. And we send them money to them. We don't have members of the board on the committee. It's just a private entity. And so we sent them the money. And once we send them the money, you can decide to say, we're going to consider the $20,000 from this year to be our contribution for next year. That's up to the county board to decide.
Well, we should either ask for the money back and then rebudget or send them a letter saying, hang on to that 20,000 because we're not budgeting 20,000 for next year.
Yeah, that would be the decision for this committee and for the full county board to weigh in on, is saying, remove $20,000 from the 2021 budget from the county fair.
So Laura, I'll make a motion that we remove the 20,000 for the county fair and direct the administrator to send whoever got the money a letter saying that it's being removed from the 2021 budget because you're going to hang on to the money you got this year.
There's a motion. Is there a second for it?
Ron will second that.
Okay, there's a motion and a second on that. And I do see here that Heather messaged out the full amount of $20,000 was paid out. So all those in favor, please signify by saying aye.
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 Hang on, we got somebody who wants to speak.
Okay.
Go ahead.
Just a couple of easy
This
things.
is introduce yourself.
Yeah, Gary Murdock, County Board. For the future, it'd be nice if some of these outside entities would send the county like their annual statement. A good one would be the county fair. So that the finance committee and the full board look at where our money's going. It shouldn't be real hard. I commend Pat Dowse for giving us a breakdown of what our money's doing for them. So it wouldn't be that big of a deal. My other quick point is to Clark. what happens if our revenues from some of our operations, say the forestry, come in higher than we anticipate? Obviously, we'll already pass the budget, but would that money just flow into next year and have excess funds to be used somewhere else?
Since I'm not the financial director, my gut guess is that would be basically money that would go and basically restore the general fund. So we're taking money out of the general fund, it would go back into the general fund. It wouldn't be available unless we rebudget it for something else the next year, if we want to take it back out of the general fund. So if all of a sudden those mills open back up, and instead of $550,000, they get $800,000, that would go a long ways towards restoring our general fund, which we're taking $250,000 out.
Good, thank you.
Yep. Thank you, Laura.
I think Gary's right on that too, about getting those reports sent to us. All right, is there any more discussion on the budget? I keep hearing something and I don't know if it's somebody wants something.
Go ahead.
Okay, I wanted to back up to two cars for human services. Is there an offsetting savings in mileage reimbursement in their operating budget?
Yeah, so it won't be that amount of money. Right now we spend approximately $76,000 on mileage, paying employees to drive their private cars in Health and Human Services. And that's because there's many employees driving many of their vehicles. So 2 cars will not cover that entire amount, but there will be a decrease in mileage expense from Health and Human Services for utilizing those 2 vehicles. And for me, the more important issue is the liability issue, which is a person taking a child, let's say child protection, and they're hauling them in their own private vehicle and they get into an accident. That's an insurance nightmare for our staff. I would hate to see our staff to get caught between their insurance saying, well, you're on work time, so it's not our cost. The county's insurance company is saying, well, it's your private car, your private insurance should cover it. And then the child has to be, helping medical insurance and lawsuits. It's just total mess. It just scares me. I'm just like,
that's understandable.
Yeah.
But I was just kind of curious if it will pay for itself.
The whole concept of having county vehicles in the long run, they will pay for themselves because you're not paying people to own a car. So. Dick, did you have something to say?
Yeah. What I would like you to do,
Is Dick by a microphone? I can't hear him.
Bring it closer to the master.
I don't know if this is on or not.
There we go.
Is it better?
A lot better.
Yeah, Mark, Max, council check into the possibility of raising the sales tax on this printout that you gave me, but all that money is telling you what the set amount is. It doesn't say what we can do about it. I read the whole thing like 3 times. I can't find anywhere in there how that can be changed. So when you haven't checked it out, think that's a possibility.
Yeah, I
source of revenue.
Yeah, I can, Dick, basically what Dick is referencing is, can we basically, so there's like 67 counties in the state that have added the 0.5% sales tax to help fund county operations, and all of them are at 0.5%. The question that Dick has is, can we as an individual county add another 0.5% to that or do whatever we want on that? And I'll have Max look into that. I downloaded the law, the statute, gave it to Dick. To me, it looks like it just says 0.5%, but I will have Max look into that.
Thank you.
Could we ask the treasurer to join us for a couple of minutes? I would really like to know on the equalized value with a near 3% increase there, if that, how that fits into what we're going to be voting on as far as tax increases here. So in other words, are we looking at about a 4.37% increase as proposed, although a little lower now with the county fair money out? Or are we looking at something over 7%? I think we should know that before we vote. And then a couple of minor notes here. Tasers is spelled T-A-S-E-R-S. There's not a Z in there, it's an S. And then in the documents, it also has the county tax still showing as 0.05%, and 0.5% is 0.5%, just to clean that up.
All right, hang on. We'll see if we can find a treasurer or somebody else. Hang on.
Somebody just said Tracy just stepped out of the office in the chat, so.
What's missing on the document with the 104.37 is it doesn't show a mill rate there. If the mill rate, proposed mill rate were there, then I could figure out.
Get that out.
Yeah, I just want to make sure we know what we're voting on. Because at the moment, it feels like we're still continuing the trend over the last 5 years. And I think it's only going to get harder. I read a couple articles yesterday that they think inflation is actually starting to tick up. And as inflation goes up in time, we know interest rates will go up. And then it's going to be much, much harder to figure things out than what we have today.
Pat, I appreciate all your diligence on this.
No, we can't find Tracy, so.
Well, somebody will find her before we vote, I hope, so, or she'll get the note.
Well, we're kind of at that spot, though.
So Clark, let me ask this. In the summer, the Finance Committee said 0% increase. If we stuck to their guns on that, what modifications would you propose as options in this budget for us to consider?
I don't know. I mean, I suppose I would just go back. I suppose I'd just go back to I mean, pretty much you'd have to eliminate if you eliminated all of the capital items, you know, so no more squads or, you know, fencing or recreational officers, you know, decrease the road equipment, you know, decrease cars. I suppose we could just take this stuff out, you know, and you know, basically push the can down the road and have 4 squads next year, and you know, and decrease the highway department. You know, we have to decrease the highway department significantly. I mean, the other option is, you know, I just don't, I mean, I didn't think the problem would be this serious, because the revenue was a really movable thing, really regarding the pandemic. I mean, I suppose if I went to the sheriff's department and just decreased it by $250,000 and said, you have to deal with it, we could do that. You know, I mean, I don't know what they would do, but they would have to figure it out and just say, sheriff's going to have to cut back, and you're only going to have 14 hours of sheriff coverage, let's say, or 15 hours. I don't know what they would do.
So when I went out and got signatures late December, I talked to around 40 people, and then I went out this spring and talked to people, and with rare exception, they're pretty perturbed with the county taxes, and they just want the tax increases to be much more reflective of their situation. Social Security is a 1.3% increase this coming year, and they basically, people are saying, you guys figure it out, but we can't keep having these large increases. And in fact, you know, if we look back over those years on the tax bill, last year it went up 11.6%, but then the year before that 3.7%, and the year before that 10%. So with a compounding effect over those last 3 years, the county now collects $127.30 for every $100 it collected 3 years ago. The city of Ashland is only collecting $101.40 for every $100 it collected 3 years ago. And so, you know, the city, and I certainly went through this and suffered through it is the right phrase here. As I said earlier today, the city looked at capital expenditures as the first place to cut, and it was really painful. We didn't want to cut employees. They had 0% increases for wages for a while. But after a couple, 3 years, people really started to figure out how to make things work. And so on the capital end, departments had to basically trust each other that one person needed something worse than another person. A couple things here where if they're getting reimbursed, you know, like from the state over a 5-year period, well, those things make sense to do because you're getting reimbursed for those. Things like BART, where there's this whole group that's contributing, you would lose much more than you realize at first if you didn't have that background. So over a period of a couple, 3 years, it got dealt with. And my gut feeling is the county hasn't crossed that bridge yet. I know you've been here a year and this is a major pickle and you found some things that surprised you in terms of finances, and then there's COVID. But I think my gut feeling is we got to bite the bullet some this year to start reversing this trend. We won't fully reverse it in 1 year, but I think we've got to start, I guess to use a math term, inflection term here, we got to start changing it in the direction that we need to go. And that would be my preference. But I also know I'm not the expert on county operations in terms of if things were cut somewhere or capital purchases delayed, what are the best decisions. I would rather give the administration a number to work with on tax increase and then have you work with staff to come up with a recommendation to the full board as far as the details.
Well, I mean, it's fairly simple. I mean, if, you know, your tax increase is pretty much all in debt levy.
Mm-hmm.
You know, and so the question is, what do you feel as a committee is unimportant? What do you feel in the debt levy should we not, you know, I mean, we can take out a couple $100,000 out of the highway department. I mean, that would certainly go a long way towards helping it. I mean, if you're going to get down to $1.2 million, you know, you got to decrease this by what? $600,000. So, you know, don't have capital improvements, don't have data processing for sheriff's department or courthouse. Take out a couple $100,000 out of the highway department, which is, you know, I mean, they're gonna be buying these things, and if we're not gonna let them buy them, you're just pushing the can down the road. But you don't have to do cars for HHS. You have to do the loans because you've already committed yourself. You don't need tasers. They could just go without tasers. Radio Link, you have to pay the $76,000 because otherwise we won't have dispatch. Radio Connect, you don't have to. You don't have to do squads.
You know, I guess one way would be to sort of meet you in the middle, you know, between the 1.2 and the 1.8, you know, say at 1.5, and it makes progress on the budget. And then a year from now, with input hopefully from the public on a survey, and we know what the referendum outcome is, because one way or the other on the referendum outcome, then you have direction from the public in terms of what level of services that they're willing to support and they want. So some of those items, yes, you may get them later, but at least it gives you some time to see what the public says on the referendum and to look at other ways of addressing the budget issues to change the direction that the county's been under for a number of years.
That's a committee decision. This is my recommendation. This is my recommendation. If the committee doesn't want to, my recommendation was to pass the wheel tax, and the board couldn't come up with a motion to consider that. And my recommendation is this budget. If you don't want that recommendation, then just give another recommendation and we'll make it fit. And whatever, we'll just, if you want to say 1.5 and you get the votes for that, ultimately the county board, I will also bring this back to the county board. County board can weigh in and decide if they want to do this, because ultimately it's a county board decision.
It would really help me if I could find out on the equalized value, the answer to that question. But as far as addressing this, I guess I'll make a motion that.
Hold on a second. I got interrupted on that last motion, and I know we voted, and I did not hear Martin, and I didn't get
Okay.
on his vote on that $20,000 for the fairs and exhibits. So, because Clark said that Gary had something to say, and then I didn't get to say motion carried. I did hear Pat and Ron, and I didn't know what Martin's vote was, and I want to make sure and check that, and then we can have that piece passed. Martin, did you? Okay, thank you. All right, then that motion carries. Now go ahead, Pat.
I'll make a motion that we approve the version 2 budget with an adjustment that the total debt levy be no more than 1.5 million. So version 2 restored the cuts to the outside entities, and the administrator has 1.8 million on the debt levy. He had mentioned we could go down to the 1.2, to get towards that 0. The 1.5 would be meeting partway in between. So he would work with staff to reduce the debt levy to 1.5.
Ron would second that.
Okay, there's a motion and a second. Any discussion on this?
Repeat the motion, please.
The motion is to approve version 2, which includes the funding to the outside entities such as BART and the ADC, et cetera. And then to direct the administrator to work with staff to reduce the total debt levy in that version to no more than 1.5 million, as opposed to the current 1.807540.
Okay, was there any more discussion? Hearing none. I think we'll need a roll call vote on this.
Okay, Laura,
Aye.
was that an answer? Yes or no?
Yes. Yes. Aye. Aye. Aye.
Pat Kinney,
Yes.
Marty Vitek,
I'm going to vote no because I don't really understand the.
Ron,
Yes.
3-1.
Okay, that is passed. So there's going to be some cuts in that we have to do.
And then that's the administrator, when you bring this to the full board and in the packet, if you could have a line in there that shows the mill rate, which I assume they would at that point. And then also, and maybe just a paragraph to clarify how the increase in equalized value affects the number of thousands that people are paying on, so that we understand, are we voting on an increase such as the one that we just saw there, or if it's going to be more than that on the actual tax bill due to the increase in equalized value.
Okay. So what will happen here is we're going to publish this budget next week and then go before the county board. I'm not aware I'm not aware if the county board can change that. Maybe they can change it on the 10th and make adjustments because you've already publicized it. Lori,
Right.
Lori, are you familiar with that?
I do believe it can be changed at county board.
Okay, all right, so we'll present basically the recommendation of the administrator and then the recommendation of the finance committee. And then the board can take a vote on that, and if they decide to go one direction or the other, that will pretty much just affect the, it'll affect the debt levy basically, so. Okay.
Okay. Thank you guys for all your questions and your assistance. Next is our verbal administrator updates.
Don't really have any updates for the finance committee outside of we will be having an executive session and the executive committee next week on the 20th to go over on the opiate lawsuit issue. That will affect the finances of the county at some point and the distribution and the methodology that we're using to distribute those funds that comes from the possible manufacturers, distributors, and pharmaceutical companies. So basically between those three, there's some issues that I'll be updating in executive session. This will be on Zoom. If you wish to attend that meeting, after we get done with the agenda, we will be going into closed session. Any county board member can remain in the closed session on Zoom or in person, and then we'll be going back to open session after that to finish off the meeting. So I just wanted, from a financial aspect, just wanted to update on that. Yeah, that's all I have.
Okay, next meeting date. What do you have on our hard dates? Clark?
We're at the 15th year. County board is on the 10th of November. Do you guys normally meet in December at all?
I do not believe we have.
Anybody here at history, do you guys normally meet in December for finance or? I apologize, I don't have the history enough to know if we need to meet or not.
Well, at least on the city end, we didn't because the budget's just getting approved, et cetera. But going back to the issue of having a survey and a referendum, I think there's work that needs to be done ahead of that. And I think I would leave it to the discretion of administrator and staff how soon you'd want the finance committee to be involved with preparing public information and a survey ahead of a referendum in April. And part of that is just simply setting priorities for the county to articulate, what you see as the needs for the county, what's important, and having the finance committee and board weigh in on that too, as far as our perspectives, so that the public can then respond to that information.
Okay. We can meet on the 19th of November or 17th of December. Your guys' choice.
Any of those work out better for anyone? Why not shoot for December then? What,
Finance, 17th of December, 9 a.m.
17th?
17th of December, it's a Thursday.
Alrighty.
okay.
Okay.
Thank you guys for all your work, and I know coming up with places to trim is not going to be easy, but I, like Pat, also worried that if we continue just doing what we're doing, we're going to still be exactly where we are. I would entertain a motion to adjourn.
Ron will make a motion that we adjourn.
Is there a second?
That will second.
Okay. All those in favor, please signify by saying aye.
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 Okay.
Hey, Lori, you can quit recording.